financial advisors, planning for life. Wealthway Financial Advisors, planning for life.
And good evening, Hampton Roads. Welcome to another edition of Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm your host, Certified Financial Planner Kevin Zivna, coming to you live like I do every second and fourth Tuesday of the month to dialogue with you, take your calls if you have a question or comment relating to your own personal financial situation or anything I'm talking about tonight. Jump on the phone lines, give me a call, 627-7979. All we need is your first name, city you're calling from, and no matter what I'm talking about, if it's important to you, then it's important to me. We'll get you right on air, 627-7979. Wealthway Financial Advisors is the proud sponsor of Dollars and Common Sense. We are an independent registered investment advisor, which means we're legally held to a fiduciary standard to put our clients' interest ahead of our own in any business dealing or recommendation that we make, and that's the way it should be when you work with a financial advisor. As the premier financial planning firm in Hampton Roads, we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. So by design, we can't work with everyone. We work with a relatively small group of high net worth individuals, but that's one of the reasons we feel so strongly about coming here every second and fourth Tuesday, and that's to reach out and help as many people in the Hampton Roads listening area that we can achieve your measure of financial success, because it is a core belief at Wealthway Advisors that the overwhelming majority of people in this country have the opportunity for financial security if they choose it. And it is a choice because it takes some time, it takes some effort, and it takes some knowledge. We are here to help. You got to take that first step, though. Pick up the phone. Give me a call, 627-7979. Whether you want to talk about anything having to do with the investment markets, the economy, insurance products like life insurance, health insurance, property casualty, taxes, tax planning, tax reduction strategies, retirement planning, retirement plans, 401ks, 403bs, TSPs, mortgage options, Social Security claiming strategies, or estate planning, wills and trusts, all that and more falls under the umbrella of personal finance. We are here to discuss tonight, 627-7979. Okay, tonight we're going to talk about it. We are going to talk about the markets. We are going to talk about markets and investing in turbulent times. So, longtime listeners to the show know that normally we don't discuss short-term market movements up or down because that's really not the nature of investing. The nature of investing is long-term a pursuit. It's not designed to be short-term focused. So short-term gyrations of individual stocks or mutual funds or ETFs or market indexes are really not relevant to long-term wealth creation. They're usually just a passing blip and not worthy of special analysis or attention. However, it is true that occasionally we will make an exception when circumstances intrude on ordinary daily life. And if you're starting to hear rumbles about market pullback or gyrations, and you're starting to see that in your news feed or on the nightly news or in talking to friends and coworkers, then I feel it is appropriate to occasionally address these market movements, what they mean, put them in historical context, hopefully give you peace of mind and a perspective on what has happened thus far, and then maybe some tips and strategies for how to deal with it. So, most politics and news are just noise in the system. And let me say that again. Most politics and news are just noise in the system. And they are not something that should be reacted to from an investment standpoint. You cannot build good, solid, long-term investment policy or strategy from short-term market movements or from which party is in the White House or which party controls Congress. There is no statistical correlation between the political party of the sitting president and the performance of the U.S. stock market. There have been good upward moving stock market performance with Democrats. There has been bad downward moving markets with Republicans as the president, and vice versa. There is no party that has a claim on moving the markets in any one particular direction, and that's as it should be. Politics, by its nature, is also typically longer term, at least at the federal level, and while it can and does have short-term influence over stocks and the markets, long-term, it's pretty negligible. Doesn't matter who's in office. So there's no reason to get all wrapped up into it. And many of the policy suggestions that come out of Washington, D.C. get dramatically watered down by the time if they even get to the point of becoming law, then they typically get watered down to the point of not having much significant long-term impact. So for those many reasons is why we don't really react to short-term market movements and don't really discuss them too much on the show. But this is one of those times when we're going to make an exception. So let's talk about it. Let's talk about what's going on out in Washington, D.C. and what is causing the market to do in the short term. So I think most people are probably aware right now that President Trump has installed and or increased high tariffs on the goods that come from foreign countries into the U.S. So a tariff is like an additional tax on those goods that come into this country. Those tariffs will be paid for by someone. Now, they're typically paid for by the importer, the company that is receiving them into the country, or the country who manufactures those goods. They get levied on top of them, and then the person who bought them needs to pay them. So if you're a company and the tariffs on the widgets that you get from Taiwan just have a 25% tariff, they just became 25% more expensive. Okay, something has to happen there. You have to pony up more cash now. You have higher expenses in your goods that you imported. And now you have a choice. You can 100% try to eat that cost and keep the prices the same on the goods you use those widgets to manufacture, or you could 100% take that 25% and increase the prices on the goods that you sell with those widgets from Taiwan and pass that increased cost on to the consumer, or anywhere in between, right? Maybe the manufacturer, importer eats half of it and passes half along to the consumer. Whatever the importer pays for is going to reduce their profit. And you can get away with that for a little bit. But eventually that starts to weigh on the bottom line. And if you are a publicly traded company, that is not good for your bottom line. And that means less profit than anticipated. And less profit means that your company becomes less valuable, at least for a short while. And if your company becomes less valuable, then people start selling your stock at the current price level because it's not worth as much as it is currently, and that the more sellers than buyers drives down the stock price of your company, all because of these excess tariffs that are levied onto the products that come into the United States. So ultimately, so that's what we're seeing happen right now, is the prospect of these tariffs being implemented, increasing costs for companies, reducing profit, which reduces the value of the company, which reduces stock price, which has caused the market to decline rather steeply in a short amount of time. And it is true that if all these tariffs stick in their current form for an extended period of time, then we are most likely to see reduced demand, reduced consumer demand, right? Slowing of purchasing. All of a sudden, everything baseball bats are more expensive. Bowling balls are more expensive. Cars are more expensive. Refrigerators are more expensive. Everything's more expensive. Well, when price goes up, demand goes down. People say, I'm not going to pay that much for a refrigerator. I'm just going to wait. So that slows down economic activity. You slow down economic activity enough, you get what's called a recession. When the GDP of the United States, or the gross domestic product, a measure of economic activity, declines and regresses, then you have a recession. And a recession is detrimental to stock prices of companies, and it gets reflected into market movement. So that's what's happening. Okay, that's real for right now. It's what's roiling the U.S. stock market, and it's causing concern about potentially causing a recession. But investing and financial planning are, by their very nature, long-range pursuits. And overreaction to short-term movements, no matter what causes them, is almost always a losing proposition when it comes to investing. The difference between investing, a lot of people you say that when they invest money in the stock market or in a mutual fund or in a stock, whatever, that they're playing with some money. I'm going to play with a little bit of money. I'm going to buy some of this sexy stock over here, some NVIDIA, and I'm going to see what happens. I'm going to play with that money. We don't play with anybody's money. We're in the business of making people money long term. So we don't play with anybody's money. But there's plenty of individual investors who do just that. The difference between investing and gambling has to do with length of time. So when it comes to proper investing, that by definition is a long-term pursuit. So when we would define anything long-term as 5 years or longer, typically closer to 10. Anything short-term, 0 to 2 years, and 2 to 5 years, kind of intermediate term. So any money that you need for an upcoming purchase, whether it's your kid's college education, a new car, addition on the house, or whatever, within the next 2 years, should be probably tucked away in a bank account or a CD or a money market account, just earning nominal interest, but also protected from short-term declines. Money that you don't need in at least 2 years, you can afford to then invest in the market, because probably speaking, 2 to 3 years into the future, we are most likely to you will most likely to have your investments would have gone up in value. Not always, but probably they will. So investing is long term. Gambling is when you are treating the stock market more like a casino, and you jump in when you think the market's going to go up, and you jump out when you think the market is going down. And no one can do that effectively. No professional can do that effectively on planet Earth. No AI-generated gizmo can do that effectively. In the short run, on a day-to-day basis, even week-to-week, the market is perfectly random. And you cannot predict randomness. So if you engage in investing on a short-term basis, you are almost certainly doing it wrong, and you almost certainly are going to lose money. Once you step foot in the casino, the odds are against you. Like I used to think it was black or red on the roulette wheel. It's not quite 50-50 because there's a green on there, I think. So anyway, it's close to 50-50, like your best odds, any game in a casino. It was the roulette wheel. Somebody told me, though, that if you are a skilled blackjack player, then you can you have slightly above a 50% chance of walking out a winner. But almost everything else is below 50%. So the longer you stay in the casino, the greater the probability is you're going to lose money. You know, all the decadence and glitz of Las Vegas was built on the back of losers, not winners, right? So don't treat the stock market, don't treat investing like gambling. Think of it as a long-term proposition. This is part of that process. And whether you are in the accumulation phase of investing, you know, you're still working, contributing to your company retirement plan, or in the distribution phase when you're maybe approaching or into retirement and living off those assets, does impact how you react to situations just such as this. We'll get into more of that after this short break. Jump on those phone lines. Give me a call, 627-7979. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, the president of Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, you can look us up online at wealthwayadvisors.com. All right, tonight, we're talking about markets and investing in turbulent times, which seems like we're having out of Washington, D.C. right now, for better or for worse, depending on your point of view. Let's talk about what to do about it and put some of these market movements into context. So, as we sit here today, the most recent, or I should say, the all-time high on the S&P 500 index, and that's the one I tend to look at the most. The Dow is kind of antiquated right now and only has about 30 companies in it. The S&P 500, I think, is more representative of the U.S. economy as a whole and the U.S. stock market, at least for large companies. But the S&P 500 all-time high was just about a month and a half ago. February 19th, 6,147 points, S&P 500. As of this afternoon, the S&P 500 closed at 4,983. That is down 19% from that all-time daily high. What we normally consider a correction in the stock market is a decline of 10%. We've surpassed that. What we normally call a bear market is a decline from peak to trough of at least 20%. We are knocking on the door of that. But bear markets, while not pleasant to endure, are also not a unique phenomenon. They happen on average about every 6 or 7 years over the last 100-year period. So they are a normal and natural part of the U.S. stock market behavior. All right, let me pause right there. See, we have a caller on the line. We're going to go up to Buckrow Beach and speak with Alan. Good evening, Alan. You're on Dollars and Common Sense.
Yes, sir. I love the show. I just want to make a couple comments, and I'll take your comments off the air. You were making some great points that I didn't understand about, kind of like getting in and out quickly in the stock market and everything, opposed to doing long term and it being, kind of like gambling. You can win and lose like that. But now, I'm not accusing anybody of anything, Kevin, but I remember back in the day, sir, I think that lady, Martha Stewart, she got in some kind of trouble for kind of getting in and out quickly and avoiding big losses. And one time, not that long ago, I heard that Nancy Pelosi or her husband, possibly, not accusing anybody of anything, but multiple times also jumped in and out in quick stages and avoided major losses. And there's got to be, I guess, some kind of penalties for that. And I'll just take your comments off the air.
Okay, Alan, thanks for the question/comments there. I appreciate that. Well, first off, it's certainly not illegal to buy and sell often and quickly in the market. That is entirely possible. But when most people do that, then the odds, their probability of success declines precipitously, and investing properly over an extended period of time, the odds are exceptionally high that the money you invest today will be worth more at least 5 years from now, and most likely 10. So you have a high probability of success if you give it enough time. If you buy and sell in short-term movements, less than a year, less than 6 months, even on a weekly basis, now you change that probability of success against you. And when the probability of winning is against you, that's called gambling. When the probability of winning is with you, that's called investing. So investing by its nature needs to be a long-term proposition. And then while you can do it on a short-term basis, and plenty of people do day trading for as long as they have money to do it, but you can do it. That doesn't mean you're going to be successful at doing that. We're going to have to take a short break here for the news, Alan. I'll make a comment or two about Martha Stewart and Nancy Pelosi when we come back from the break. 627-7979. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, the president of Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized, ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, you can look us up online at wealthwayadvisors.com. Once there, you can request an information packet to find out what it's like to work with us, or sign up for a free quarterly newsletter at wealthwayadvisors.com. Just go to the Request a Consultation page, put your name and address in the dialog boxes there, select the appropriate drop-down menu, and we'll get that information out to you later on this week. And that's all we will use your name and address for, is just to send you the information that you request. Or if you have some nuanced questions, want to speak to a live human being, give us a call at the office, 456-2200. Want to remind everybody, our next live show will be in 2 weeks on Tuesday, April 22nd. But if you can't catch us live every second and fourth Tuesday at 6 p.m., get the show as a podcast. Search for Dollars and Common Sense wherever you get your podcast. Download us, take us with you wherever you go. Listen at your convenience. And for those of you into social media, we have a presence on Facebook and LinkedIn. Search for Wealthway Financial Advisors, hit that like or follow button, and then usually once every week or two we put up an interesting and informative financial planning post to keep you engaged in the process. All right, tonight we are talking about markets and investing in turbulent times. We're hitting it head on here today. Follow up on Alan's question right before the break. He mentioned something about Martha Stewart, Nancy Pelosi, and getting out of stocks quickly. I don't know much about the Pelosi situation, but I think as it related to Martha Stewart, it was more insider trading than it was any sort of quick buying and selling, day trading type of situation. And so when you are a board member of a publicly traded company, you are held to a fiduciary standard to do what is in the best interest of the shareholders of that corporation. And part of that fiduciary duty is agreeing that you will not use any of the information that you learn as a board member to make strategic trading moves about the company. You can buy and sell the company's stock on the board on which you sit, but you have to do it in a very controlled, disclosed, slow, methodical manner, so that you don't even give the appearance that you're using inside information to take advantage of company stock price. So, Alan, as it related to those particular situations, at least Martha's anyway, I think that was more insider trading is what caused her to take a little time out for a while there in a correctional facility. All right, back to some of the things we were talking about the market. I was describing where we are right now on the S&P 500 is down about, as of this afternoon, down 19% from its all-time high of February 19th, and that a bear market is considered 20% decline or more, and here's an interesting stat that most people aren't even aware of. The average annual intra-year decline, so the average annual calendar year decline in, let's say, the S&P 500 index is 14%. 14%. So on average, every calendar year, the S&P 500 goes down 14%. Now, as an average, of course, it doesn't happen every single year like that, but a decline of 14% is normal and natural in just the normal course of investing. So 20% of what is widely considered a bear market is not too far away from that. It's not so far. The decline we've experienced is not out of the ordinary. Some other statistics to put this all in context. A bear market occurs on average about every 6 or 7 years, or at least it has over the last approximately 100 years. So every 6 or 7 years, we should expect a decline in the S&P 500 index of at least 20%. We should expect it because on average, that's what has happened. So it's not unusual. It's not out of the ordinary. So the last bear market we had was in 2022. That was caused by unexpected spike in inflation. Before that, 2020, COVID, right? And then before that, 2009. That was the housing crisis. So while we don't officially have a bear market yet, if we do close in bear market territory on the S&P 500, then that will be 4 in the last 16 years, about 1 every 4 years, which is on a faster pace than the 6 or 7 over the last 100 years. But despite that, it was only a month and a half ago when the S&P 500 hit its all-time high number of 6,147. So again, these movements of the market are not out of the ordinary. They are relatively routine. We don't know we never know, no one knows what's going to cause them or exactly when they're going to happen, but we do know they're going to happen. Something is going to happen on about every 6 or 7 years to cause a 20% decline or more. Few more statistics to keep in mind. The average bear market from peak to trough, so from the previous high point of an index to its bottoming out time, it's about 10 months on average. And then the recovery from that bottom, that trough, to reclaiming its previous peak takes about 17 months on average, or about 1.5 years. So those, again, are normal average numbers. This type of movement, this type of volatility is the price, the short-term volatility is the price that good long-term investors willingly pay in order to get elevated average annual rates of return of 8, 9, 10, sometimes 11% on average per year. Now, you're not going to get that every year, But that's why you've got to hold on through these periods of time, and hold on for an extended period of time in order for the averages to do their work. Any money that you need less than 2 years should probably not be invested in stocks, mutual funds, ETFs, the market. It should be sitting in a bank account, because 2 years is about the time frame of, if we go through a bear market, that's about the recovery time that it takes to get back to where you were. So it would be prudent to make sure you have an ample emergency fund of money set aside, not subject to short-term market fluctuations. All right. So how do we handle things at Wealthway? So first off, good investment management is systematic, formulaic, and process-driven. Good investment management is a system and a process. You will not get that information from CNBC. CNBC is hazardous to your wealth. They encourage short-term trading. Short-term trading changes the odds of success against you, and your odds of failure increases. Good investment management is systematic, formulaic, process-driven. It is decidedly not sexy. It's boring. We do boring investment management at Wealthway. Why? Because that gives you the highest probability of long-term success. We invest our clients' portfolios for growth and put in place strategies to protect their lifestyle. So we diversify the portfolio, which means our clients' investments are spread out across a wide variety of investment options. We rebalance our portfolios annually to bring them back in line with the original allocation, and we do not attempt to time markets, because no one on planet Earth can do that effectively. That is a losing proposition. Anyone who tells you that they can time markets effectively is lying to you. Anyone who is even suggesting that they have a hint of ability to consistently time markets is trying to fool you. So, buyer beware. You're not going to hear this on CNBC. You're not going to hear this on most financial news outlets and news channels that are interviewing all sorts of experts nowadays about what should you do now, where should you reallocate your portfolio, what should you sell, what should you buy. You should stick to the plan is what you should do, and not panic. So our preferred investment vehicles are a mix of low-cost exchange-traded funds and some actively managed mutual funds. Generally speaking, we do not use individual securities like stocks or bonds, because a company can go out of business, which means its stock will go to zero, stay there, and you have permanently lost that money. With exchange-traded funds and mutual funds, we take that risk right off the table. It's virtually impossible for a mutual fund or exchange-traded fund to go to zero. Virtually impossible. And so with those investment vehicles, there will be fluctuations in value, but you will not permanently lose money with the proper investment allocation to those vehicles. Then we accept and we coach and we teach our clients to accept short-term volatility as the price for those higher long-run rates of return. It's times like these, right now, right here. This is why we plan, and this is why we prepare. This is why we do our deep, detailed, analytical financial planning in conjunction with our investment management. Because investment management by itself is of limited value. All you get out of investment management is a rate of return. And heck, a lot of brokerage statements still don't even put your rate of return on the brokerage statements. They don't want you to know what your rate of return is. We do that. We do the math for our clients. We have special software. So all our clients know precisely what their individualized rates of return are. But investment management only gives you that rate of return. It doesn't tell you what, if anything, to do. So by integrating investment management with ongoing analytical financial planning, we can do a probability analysis of your assets lasting your lifetime at current spending levels. If we start to see our planning numbers change in a negative direction, then maybe we might proactively recommend some suggestions on how to handle that with our clients. I'll talk more about that when I come back from this last break. 627-7979. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, the president of Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, you can look us up online at wealthwayadvisors.com. Once there, you can request an information packet to find out what it's like to work with us, or sign up for a free quarterly newsletter at wealthwayadvisors.com. Or if you want to speak to a live human being, give us a call at the office, 456-2200. Our next live show will be in 2 weeks on Tuesday, April 22nd at 6 p.m. as usual. But if you can't catch us live every second and fourth Tuesday of the month, then get this show as a podcast. Search for Dollars and Common Sense wherever you get your podcasts. Download us and take us with you where you go and listen at your convenience. All right, tonight we're talking about markets and investing in turbulent times. And then I'd like to spend the last few minutes of the show here talking about what you can do about it, if you need to do anything about it. And I would say most of you do not. Keep doing what you're doing. Keep on keeping on. But let me give you a little bit of things to think about here. First off, opportunity is born from chaos and uncertainty. I love times like this. I love it. Everyone, nearly everyone, is panicking. Their hair is on fire. They don't know what to do. There's chaos, it seems like, in Wall Street. So what? Who cares? Good. Let everyone else panic while you stay calm and keep a level head, because that's how you make money long term. One of the things you want to make sure you do is protect against the big mistake. The big mistake is giving in to the panic and selling out a good diversified investment portfolio, locking in losses, and then missing the big rebound. So don't make the big mistake. You try to avoid the big mistake by eliminating or at least reducing any of the anxiety and fear around what's happening with your investment accounts. Hopefully some of the statistics I've given you tonight has done that. So far, what we're experiencing is relatively normal. It's not out of the ordinary. It should even be expected for people in the financial services profession to plan for, like we do for our clients. So don't panic if the movements are largely normal. Okay? And one of the big things you can do is reduce your amount of news intake, because the news, especially negative financial news, is designed to agitate and will most likely cause you to do the wrong thing at the wrong time and make the big mistake. And I know that this happens with regularity, because Fidelity and Vanguard publish studies almost after every bear market. Vanguard, where almost all do-it-yourselfers, so individual investors. Fidelity, the largest provider of 401k plans in the United States. So again, most people self-manage their 401k. So they have their finger on the pulse on what individual investors do in times like this. And overwhelmingly, individual investors sell low, sell at the bottom. They panic. They cash out. and they don't get back in. The cash flows don't come roaring back into the investments until after there's been a 10, 15, 20, 25% recovery. And so they've locked in they've sold low, they've locked in their losses, they didn't get the recovery, and they've permanently lost that money, and now they're not going to catch up. And that's going to severely damage their long-term planning numbers to hopefully, that might mean that instead of retiring at 60, you have to work to 62 because you made the big mistake. So don't make the big mistake like it's something like 2/3 of people at Fidelity and Vanguard. The numbers are very consistent. And sell at the wrong time and buy at the wrong time. No, you don't pick a time to sell and buy. You invest when you have the money to invest, and you sell when you need the money to spend. You don't let the market dictate your actions. You let your lifestyle dictate your actions. For those of you in the accumulation phase, still working, still saving, relatively simple and easy. If you have not started contributing to your company retirement plan, tomorrow, go to HR, get on your payroll website, whatever. Start contributing to your company retirement plan. If you're already contributing, now's a good time to increase the amount. You're buying more shares at discounted prices. And most importantly, do not panic sell. I don't care how low the stock market goes. If you are still accumulating, you don't need this money today. You need this money 10 years from now, 20 years from now, 40 years from now. This is an opportunity. These are the times when the money is made. You buy at these previous discounted valuations from just a couple months ago. You're going to look back from 3 years from now and saying, man, I wish I had bought even more. I wish I had invested more at these lower valuations. So this is the time when the money is made if you're an accumulator. Don't stop. Now, if you're in the distribution phase, if you are in retirement and you're living off your investments, well, that does require more planning and strategy. The first 3 years of retirement are the most pivotal, and too high of a withdrawal rate in an early down market can significantly reduce your lifetime spending. So you want to make sure you have 1 or 2 years of portfolio withdrawals, whatever that number would be, set aside in a bank account as a security blanket and a cushion. And when we do our financial planning analysis for our clients, we use sophisticated probability analysis software where we can usually tell the probability of their assets lasting their lifetime. If that probability gets too low, then we would temporarily reduce or suspend portfolio withdrawals and purposely draw down that bank account and then look to replenish the bank account when the ultimate market recovery comes. That's all the time I have for tonight. Be back in 2 weeks, Tuesday, April 22nd. I'm certified financial planner Kevin Zivna. You've been listening to Dollars and Common Sense on News Talk 790 WNIS.